I don't think people should take mortgages with ARMs, pre-penalty payments, or balloon payments, even though I've personally done it twice. I'm a loan officer. I help people get mortgages to buy houses, sometimes refinance. In the first example, I was buying a commercial property. It was selling for about $1 million. I was offered a loan where I could put 15% down, 150,000, and get a fixed rate mortgage. When I looked at the payment, I didn't like the payment. I didn't like the rate. I really just didn't like anything about it. I went back to the bank and I said, if I take the down payment from 15% to 30%, that's increasing my down payment to 300,000, will that reduce the interest rate? And it did reduce the interest rate a little bit. I said, okay, what are my other options? They said, well, what about if we give you a balloon payment? I was like, what does that look like? They said, well, what we're going to do is we're going to give you a 25-year amortization. So the payment's going to be calculated over 25 years. But at the 10-year mark, you have to pay the loan off in full. So whatever the balance is after 10 years, it's due in full. And I was thinking to myself, okay. I was like, but what does that bring the rate to? And they told me, and I was like, well, that's really not that much. They said, well, in addition to that, if you'd like, we can give you a 5-year pre-penalty payment. I was like, okay, what's the pre-penalty payment look like? Initially, what they explained to me was that the pre-penalty payment would be 3% of the balance if I decided to pay the loan off early for the first 5 years. I said, okay. I said, how about if I offer you guys this? Because when you're doing these type of loans, sometimes you can negotiate with the bank. I said, how about I'm fine with the balloon payment after 10 years. That's cool. I said, but on the pre-penalty payment, I would like to do a step down pre-penalty. So for the first year, I'll pay you a 5% pre-penalty. The second year, 4, 3, 2, 1. So the pre-penalty payment would go down year after year. As long as the longer I kept the loan, the lower the pre-penalty payment would be. And then after 5 years, it would go away to nothing. But I also wanted worked into the deal that if I decided to sell the property or if I decided to pay the loan off with my own funds, not refinance, there was no pre-penalty. And they accepted it. And that's how I ended up getting that loan. In the second scenario, I was buying an investment property that was selling for about $400,000. I was putting 20% down, and I was offered a 7-year ARM. In that particular case, I was thinking to myself, I'll take the 7-year ARM because I had another property that had about 5 years left on the mortgage. I knew that when I paid that house off, if the time came when the 7-year ARM flipped from a fixed to an adjustable, if I was refinancing into a higher rate environment and it was going to hurt me, I would be able to get equity out of that other house and just pay that property off in full. So it made sense to take that loan. If you don't fully understand how you can negotiate and what's available, I would recommend a 30-year fixed. It's much safer.